Hello, I'm Finola Burke from RaaS, and welcome to our 2023 Outlook series. In this session, we're focusing on data and insights and media company, Pureprofile, ASX ticker PPL, and joining me is CEO Martin Filz and COO Melinda Sheppard. Welcome, Martin and Melinda, to our Outlook series.
Thanks, Finola.
Hi, Finola. Great to see you.
Hey, good to see you, Martin. Now, we've started this year on a positive note. You've started this year on a positive note with the release of your Q2 revenue, which is up 21% to 12.8 million. And EBITDA was 1.2 million, which is down on the PCP, but in line with the margin that you've given as guidance. Melinda, can you talk about the key drivers behind the result?
Yeah, sure. Thanks, Finola. So as mentioned, our EBITDA was in line with our margin was in line with our expectations. The variance and the reason that we were down year on year is a combination of some one-off costs plus some other what we would call a little bit of anomalies that we wanted to point out to our investors or potential investors. So the first one is a loss of rental income. We had a sublease in the UK that we gave up at the end of FY22. That contributed about $500,000 worth of income to our bottom line result over the prior years, and so that's impacted us by $245,000. We also opened up an office in India where we've got a really large contingent of our team. We haven't had an office there for a couple of years, and that was a really important thing for us to get our team back coming to an office. And so that was sort of I wouldn't say a one-off cost because it'll start to be part of our operating expenses moving forward, but we haven't had that cost in our P&L or our cost base for a couple of years. So we wanted to point that out. We had a foreign exchange loss of about $107,000. We know that the pound and the US dollar kind of moved around a little bit over half one, and so we did have an impact related to that. And then finally, we actually had a bad debt provision that we took up of $115,000 in half one. We're quite hopeful that we'll recover that debt from that UK client, but as a precaution, we've provided for it in our accounts, and hopefully we'll be able to reverse that when we put out our full year accounts in August. So they're kind of the key drivers behind the reason that we're down year on year. If you kind of stripped all those out, those weird anomalies to some extent, it would obviously be positive year on year.
Just to add, Mel, because it's quickly forgotten, we actually talked about this in quarter four in our full year announcements at the end of last financial year, which is we made considerable investments in quarter four for this financial year. So hiring 5 new commercial people, focusing 4 of those people outside of Australia, as well as some of the investments in offices that Mel talked about. But 6 months later, those are now paying off. And that's why we're seeing that the revenue up year over year. And it's why we're also seeing the EBITDA percentage increase from quarter one to quarter two. So we made calculated investments in quarter four, and they're actually now paying off.
Well, Martin, thank you for that. And I've got to say, from a revenue and an EBITDA perspective, you did beat our forecasts for the quarter in any case. Martin, you touched on the revenue growth. The data and insights business is growing very strongly in both Australia and offshore, and that's the biggest part of your revenue component. Is there a shift taking place in corporate budgets from advertising to marketing and insights at the moment?
Yeah, it's a good question. We're fortunate that only 10%, slightly under now, but about 10% of our revenue is based on advertising. And as you said, the majority, 90+%, is actually on data and insights. And again, we talked about that in quarter four in the full year release. We actually closed the UK performance, the UK advertising business down at the end of last year. And I mentioned that in the release we just had. So it's great, the timing that we actually did that. And that's where you're seeing a softening across the board and on the advertising front. And there have been early markers for that. And a lot of publishers, even Google, Facebook, etc., have talked about a softening advertising and finding it challenging. You've then got data and insights, which is a completely different end of the spectrum. And the reason being is that whenever there is some sort of disruption, which we have at the moment, economic disruption compared to COVID disruption we had a few years ago. But the economic disruption means brands want to understand more about their consumers. They want to understand all of their different consumers and what are their drivers are at the moment to maybe making acquisition or future plans. Are they pulling in purse strings, etc.? And so when you think of data and insights, you can't put a net over everybody. If you are young male, female, up to 30 years of age, chances are you don't own a property, you're benefiting from higher salaries, and higher inflation is actually beneficial to you. And so if I'm a brand talking to that group, I want to understand them even more. And so more research is carried out. If you're a retiree, then you've had a long time when your money in the bank isn't earning any interest at all. Now that's earning you interest. Yes, super's been hit, but I'm now earning more day-to-day income. I don't have a mortgage, so I'm not going to be affected by that. Again, brands want to research and understand what their drivers are for everything from holidays to buying a car to buying a luxury good, etc. And then when you look at the people in the middle, again, it's not a one fit all. If I'm a main grocery buyer and I've got 2 young children and a large mortgage, yes, I'm affected by what's going on. But actually, there's a huge amount of people that don't have large mortgages, that don't live in crazy Sydney that's phenomenally expensive, that actually live elsewhere, that they, again, aren't as impacted as perhaps the news stories would have us know. And that's where we're seeing research is being conducted, data is being analysed, and that plays into our wheelhouse.
And Melinda, your repeat client business has grown very strongly. In Q2, you ended at 39.8 million, and that was up that was up 8.2 million at the same time a year ago. What's driving this growth in repeat custom? Is it the SaaS platform, for example, that's contributing to this, or are there other factors at play?
Look, there's a variety of different reasons for that. If we kind of look at how do we define repeat client revenue, if we think about the last 12 calendar months, so this is on a rolling 12-month basis, it's a client that have spent in calendar year FY21 and calendar year FY22. So if we go back to what did we do in 21, we actually hired about 11 either direct sales leads or sales support roles over that period of time. And what you're seeing with that repeat business is new clients coming in FY21 over that calendar year, and then we're retaining them because we're giving them our amazing world-class service and really looking after them, as we're well known for, and then they're choosing to spend more with us in the second year. So that's where you're starting to see, and it really talks to that investment thesis of why do we, particularly in Q4 and in Q1 this financial year, why did we hire more people, particularly sales heads? It's because we'll start to see that investment pay off in that, really pay off in that 12 to 18 month period. So that's where you're really starting to see clients spending more. So they'll come in, dip their toes in. We make sure we give a fantastic result to them. They're very happy, and then they're going to spend more, and they'll stay with us versus going to a competitor. So that's what you're seeing playing out in the numbers. It's actually the investment thesis being correct, and that's worked for us, and that's why we're going to continue to invest in that manner.
And Martin, SaaS revenues were up 29% for Q2 and 11% for the half. What are the drivers behind that?
Yeah, the main drivers are our audience builder products, where we work with organisations like Flybys that have a large loyalty membership, and then we hook into that loyalty membership. They offer their members the ability to do surveys or earn revenue or earn points, etc., by analysing data, and in turn, those individuals then made available to our clients. And that's where we're seeing particular growth. And it makes sense, again, because brands want to understand more about their client base, and they're able to do that by hooking into our audience builder product. They want to be able to offer their members another way of earning points, rewards, and again, high cost of living. That fits in nicely. Many companies want that for their members. So those are very good. And where it fits in nicely for us, I said we've got more demand at the moment. So the more people we have to do surveys and analyze data, the the better. But also where it plays in nicely for us is that we don't have to actually put our hand in our pocket to recruit members ourselves. We actually do a back-end revenue share with all of those clients that run Audience Builder. And for us, especially when there's some uncertainty, we're being prudent. And Mel and I, when we began this partnership 2.5 years ago now, one of the first goals was to be cash flow positive, which we've continued to be. And then it was to be really prudent about the business, not invest too far ahead of the revenue curve, make sure that actually everything that we do has an ROI to it. And as a business, we've still seen that, we've almost doubled in size in 2.5 years. But we've done that really conservatively. And so for us, when we look at the remainder of the year, we've only got to make a few tweaks here and there to again be prudent. And if we see any other downturn happen in the market, and people are talking about that, we're in a fantastic position that actually cash flow positive, money in the bank, and we actually run a really conservative business. So it all playing into our hands at the moment.
And Martin, you provided some very solid revenue guidance for FY23 of 48 million to 52 million range, and an EBITDA margin range of 9 to 10%, which is unchanged. How much of a stretch will it be for the business to deliver at the top end of that range?
Yeah, good bit of fishing there, Finola. Look, it's all a balancing act. Yes, there are possible upsides we got. So as I said, the people that we brought on at the end of last year can deliver faster. Some of the partnerships that we've got in the pipeline can come on board sooner. New markets could open up, be faster. So that gives us the positive angle. And then, of course, you have the slight uncertainty of the market. So I think it's great, and I've been reading other people's reports. It's great that we're able to say we're dead in the range that we say at the moment, and that remains unchanged. And as a business growing 21% in the market is today, we're delighted with that, and we're really pleased we're able to keep the guidance that we have done.
Well, Martin, Filz, and Melinda, Sheppard, thank you for joining me today to discuss the 2023 outlook for Pureprofile. I look forward to catching up with you through the course of the year to check on your progress.